Welcome back to the AI Daily Brief. Today we are talking about something really interesting. We're talking about the changing conventional wisdom around many parts of AI, but specifically in this case, an AI bubble. As we discussed yesterday extensively, the launch of GPT-5 has been extraordinarily significant, but not necessarily for the reasons that we thought. TLDR, it wasn't significant because it heralded AGI, but because it actually reset some people's expectations. You're seeing a lot of posts like this one from David Sachs that are basically arguing that the rapid takeoff folks have been wrong, that these models are incredibly impressive, but that the development is happening in a way that's competitive and yes, fast, but not likely to wipe out entire fields and job categories all at once. Adam Butler of Resolve Asset Management made this same point as well, basically saying, look, yes, AI is getting better, but it's not a straight line up in terms of pure model capacity, and that means what it's time to do is the hard work of actually integrating these models into, as he put it, the 80% of the economy that still runs on Excel and email. An interesting question is, how is this impacting how the market thinks about AI? Well, one interesting context to understand that is a story in the Wall Street Journal this week about a 23-year-old former OpenAI researcher who has very quickly raised $1.5 billion for a hedge fund that is wildly outperforming markets currently. And to understand a little bit where this came from, you have to go back just a bit. It has been extremely painful to be on the wrong side of the AI trade. People have been calling NVIDIA a bubble for years at this point, and at least so far, they've been wrong the entire time. You might remember last summer when market analysts got a little bored, and Goldman Sachs dropped the report called Gen AI, Too Much Spend, Too Little Benefit. You have to think that this thing is pinned up on notice boards across Wall Street as a cautionary tale. Because at the same time Wall Street was buying into that narrative, which if you were a listener to this show at that time last year, I'm sure you would not have fallen prey to. That same month, a 22-year-old OpenAI researcher called Leopold Aschenbrenner published a 165-page blog post called Situational Awareness. It explained where we were in the summer of 2024, where we were going, and what it was going to take to get there. In short, it was effectively a roadmap for AI investment. One of the opening paragraphs read, "The AGI race has begun. We are building machines that can think and reason. By 2026, these machines will outpace many college graduates. By the end of the decade, they will be smarter than you or I. We will have superintelligence in the true sense of the word. Everyone is now talking about AI, but few have the faintest glimmer of what is about to hit them. NVIDIA analysts still think 2024 might be close to the peak. Mainstream pundits are still on the willful blindness of it's just predicting the next word. They see only hype in business as usual. At most, they entertain another internet-scale technological change. Before long, the world will wake up, but right now there are perhaps a few hundred people, most of them in San Francisco and the AI labs, that have situational awareness." So, my friends, what do you do if you have that situational awareness, if you have incredible conviction of what you are aware of, and you feel that other people don't? Well, of course, the answer is start a hedge fund and start taking investments. According to the journal, the fund now manages more than $1.5 billion. Some of the investors include Patrick and John Collison, the founders of Stripe, Daniel Gross and Nat Friedman, who are some of the most prolific AI investors and who recently joined Meta's superintelligence efforts. And increasingly, it appears the firm has money from traditional Wall Street investors as well. The strategy is pretty simple. Buy semiconductor, infrastructure, and power companies that stand to benefit from the AI build-out, add a few startup investments, including a position in Anthropic, and chuck in some short bets on the industries that will be left behind in the AI revolution. This being Wall Street, though, of course, what ultimately talks is money, and at least so far, situational awareness has the gift of gab. The company was up 47% after fees in the first half of the year, compared to the S&P 500's 6% in the same time, and an index of tech hedge funds, who were up about 7%. Despite having no professional money management experience, Leopold was highly convicted even all the way back last year. Speaking on the Dwarkesh podcast, he said, "We're going to have way more situational awareness than any of the people who manage money in New York. We're definitely going to do great on investing." Now, Leopold is far from the only person to build a dedicated AI fund. The journal highlighted several other AI-focused hedge funds who are up big over the past year, although none have matched the performance of Leopold's fund. Wrote the WSJ, "It's no surprise that thematic funds are springing up to capitalize on the AI frenzy. In years past, hedge funds that specialized in the transition to clean energy and investing with an environmental, social, and corporate governance lens proliferated in response to client demand. Identifying a winning theme isn't the same as trading it well. Investors' tastes can be fickle. Many prominent ESG hedge funds have either shrunk or gone out of business." And yet, I think that the comparison to ESG, while some might see as an arrow in the heart of this whole AI fund movement, actually serves to explain how different AI is. In short, recent trends like ESG have been at least a little bit fabricated, by which I do not mean that climate change isn't real or that renewable energy isn't a valuable investment, but many of these ESG funds focused on arbitraging carbon markets or buying into companies that were riding high government subsidies. Basically, the general problem was that the demand for ESG investments far exceeded the good ideas that could be funded by them. That led, obviously, to terrible performance, and many of those funds are now shuttered. In contrast, the AI theme is A, much larger, and B, has been starved of capital for the scale being attempted. You can see the issue in startup fundraising. Anthropic's concession to having to take sovereign wealth fund money from the Middle East was not because US venture capital wasn't interested in funding them, it was because it didn't have the scale to fund them anymore. Now, I will say that to the extent that you're looking for a challenge for Wall Street investors, the ways to play the AI theme are fairly limited right now. A lot of it's based on the infrastructure build-out, which is understandable. I recently shared on X a chart from Bloomberg showing how data center construction had almost matched in sheer dollar terms the amount being spent on general office construction. And in that world, obviously, investing in infrastructure makes sense. But still, there are so many themes in and around AI that Wall Street simply doesn't have access to. In fact, in the absence of that exposure, traders are getting creative. Instead of just investing in AI companies, they're also trying to get out of stocks that they perceive as being under threat from AI. Bloomberg writes, investors have started placing bets on just where the disruption will occur next, ditching shares in companies some strategists expect will see fall-offs in demand as AI applications become more widely adopted. This, as we heard just a minute ago, is a part of Leopold's strategy, but it's also just a general way to play the second-order implications of the AI revolution. Bank of America recently published a list of 26 companies they think will be the most at risk from AI disruption, and interestingly, it's probably not exactly who you would think. The list is not stocked with outdated legacy companies doing boring things. Instead, it's mostly about tech companies that excelled in the last decade, who are suddenly finding that their entire business can be replaced by AI. Among them are web development firm Wix, stock image company Shutterstock, and even software conglomerate Adobe. This group has underperformed the S&P 500 by 22 percentage points since mid-May, after more or less keeping pace since the release of ChatGPT in late 2022. Gartner is another prime example of a company that's facing severe disruption from AI, with the market starting to take note. They're, of course, a research and advisory firm that makes heavy use of proprietary data and in-depth analysis, and while it would be going too far to say that their business model was made obsolete by deep research, that's certainly the concern on many investors' minds. When Gartner cut revenue forecasts at their last earnings call, the stock fell 30% over the next 5 days, their largest single-week drop on record. So far this year, the stock has been cut in half. Morgan Stanley also said that the results, quote, added fuel to the AI disruption case. Said Adam Sarhan, CEO of 50 Park Investments, there are a lot of pockets of the market that could be basically annihilated by AI, or at least the industry will see extreme disruption and companies will be rendered irrelevant. Any company where you're paying someone to do something that AI can do faster and cheaper will be wiped out. Now, we are treading in new territory here. While the PC boom and the internet did have a ton of disruption, the pace of change was much slower. We haven't really had an example of one industry threatening to take out large chunks of the market, basically ever. Said Phil First, CEO of HFS Research, Wall Street clearly has the jitters. This is going to be a tough, unforgiving market. Now, one prediction that I have is that in this context, where AI just keeps outperforming, people are going to be desperate to find indications of a bubble. The latest example of this, I think, shows why it's so challenging to try to apply historical analogies to the AI space. We've talked recently about reports that the coding platforms are spending more serving their customers than they are making in revenue, even though they're some of the fastest revenue-growing companies in history. Surrounding that, you're starting to see discourse like this one from Antonio Garcia Martinez, who I like quite a bit and think is very smart, but happen to disagree with vociferously in this particular case. Following the reports of the negative gross margins of these companies, Antonio wrote, every tech bubble is initially pumped by some extraneous source of liquidity poured into unsustainable growth. Web2 consumer used VC for paid ads growth to pump MAUs. Crypto used retail tokens to pump user rewards to inflate usage and hence the token. AI is using VC and inflated equity to subsidize compute costs and inflate consumer usage. This all also happened with railroads and the telegraph too. It all blows up at some point and the real businesses crawl out of the wreckage and eventually become titans. Nothing new under the tech sun. Now, of course, the nuance to Antonio's point is that he's not one of these doom prophets who's saying that AI is BS. He's talking specifically about the structure of the current market surrounding AI, an important distinction. And yet I don't think that these analogies hold, or at least not entirely. The argument that he's making is really two bundled in one. The first has to do with a period in any new technology's life cycle when investment capital subsidizes the cost in a way that is unsustainable. Interestingly, he didn't point to one of the most accepted versions of this, which was Uber and the whole on-demand revolution in San Francisco in the 2010s. I lived there, and my lifestyle was very much subsidized by VCs for a half decade or more at prices that no one has seen since 2016 or 2017. And so on that part, I don't disagree that AI may be being priced too low right now relative to what it will eventually be because of the subsidy of external capital. Where I disagree is with the second part of the argument, which is basically, in short, that it is only because of that subsidy that usage is as high as it is. In the examples that he gives, there was no there on the other side. Monthly active users on a Web 2.0 platform do not guarantee revenue. You have to build a thriving ad model around that, which introduces all sorts of complications and was far from a guaranteed proposition. Crypto is a whole different thing, and as someone who spent a long time in that field, frankly, outside of a very small handful of tokens, the there in terms of usage has never been a thing. It's all been speculation. AI is wildly different. You can't have a single platform like ChatGPT grow from 0 to 700 million users in 2.5 years and explain it away by just saying that they're pricing it too low. Maybe they are pricing it too low, and maybe that makes you squint at OpenAI's business model, but the argument that that's inflating consumer usage just doesn't hold water. Let's take the more recent example of these web coding tools. The reason that these companies might be losing money is because the customers want literally as much of the product as they can possibly get their hands on. That's wildly different than only using it because it's cheap. One of the reasons this challenge is coming up right now is that in addition to more and more vibe coders coming online who had never interacted with code before, more sophisticated developers are starting to employ strategies and workflows that involve spinning up multiple background agents at the same time, which definitionally do work in the background, consuming a huge number of tokens. By one example, the number of tokens processed by Google jumped from 480 trillion in May to 980 trillion in July, 104% growth in just a couple of months. And for those who have argued that costs weren't going to come down, like very notably Goldman Sachs back in that report from last year, that's also been wrong. In fact, the cost of inference has come down dramatically, frankly, much faster than anyone would have anticipated. It's just that demand is going up faster. And so companies adjust. Replit, for example, changed from charging for each completed request to instead charging for the amount of time and compute used, and their margins went right back up. The reality is that people consuming tokens for coding haven't really been put in a position yet where they really have to make the choice at scale between the most state-of-the-art model and the more cost-efficient models. I'll remind only that when GPT-5 came out, it was priced about 10 times lower than anyone thought it was going to, clearly making efficiency and cost a vector of competition. The point of this is not that markets aren't overpricing certain stocks, or that there are inflated expectations that AI will at various points not be able to meet. It is only to caution against blithe bubble comparisons that too lazily pull comparisons from the past when they simply don't apply to the new reality. Some think it's a generational thing. If there's one thing Wall Street really hates, it's losing to a kid. Young Macro writes, capital management will soon become an activity exclusively done by chronically online Zoomers. He continued, just like everyone would have called you insane in the late 20th century if you suggested that a majority of new companies would be launched by the college-age cohort within a decade or two, they've been calling me crazy for insisting on this inevitability for 3 straight years now. Now, I have no idea if Leopold and Situational Awareness's ability to keep these high numbers up will continue. I think that the more likely scenario is that Wall Street humbles itself and just gets on the train. The point is, though, for now at least, AI markets are exuberant and full steam ahead. Now, this is one that is sure to cause some debate. You can't say the bubble word without surfacing a huge array of opinions, all of which, of course, are valid. And there's lots and lots more evidence to look at in different places. So I encourage the conversation. Get to the comments, have fun with it. For now, though, that is going to do it for today's AI Daily Brief. Appreciate you listening or watching as always. And until next time, peace.